Welcome to the weekly update. This is being prepared the weekend of May 1st, where I'll look at the action in the market for the past week and then see how things look for the week of May 2nd through May 6th. And last week was pretty negative. We kind of roller coastered all over the place. By the time everything was said and done, it ended up being a pretty negative week overall. So there were a lot of concerns over earnings disappointments, like Amazon, Apple. The news was just not taken very well by these companies. We had rising interest rates, which is kind of strange because for most of the week, stocks followed interest rates. If interest rates were going up, so did stocks, and vice versa. On Friday, we did see a decoupling where interest rates rose and stocks went down. Overall, the markets are concerned that interest rates are going up. They're also worried about slowing growth, specifically economically. And then inflation, which seems to be everybody's big concern right now, as well as Fed policy. And that's going to come to a head, at least in the short term, this coming week because we have an FOMC meeting that'll be happening on Wednesday. They actually meet Tuesday, but then they meet Wednesday. And then after they adjourn that meeting is when they make their announcement. And it's about 2 p.m. to 2:15 p.m. Eastern time. When you take all of these things together, it led to a negative week. We ended up being down 3.3%. Volume was above average, and what we're looking at now are the technicals. We're pretty negative across the board, especially on the daily charts. We're looking even more negative on the weekly charts as well, and I'll go through the charts. We're still worried about inflation, interest rates, geopolitical concerns, the supply chain issues. That's what Apple was really worried about, but that's been in the background for quite a while. They're still having the lockdowns in China, and what will that do to supply chain issues? Oil, which is still over 100. Different Fed speak. If you have members of the FOMC, they come out and they do an interview or they make some kind of a speech. It seemed like no matter what they said, it was taken as negative. And then we have earnings that are coming out. As far as our trend, it's slightly strengthening and it is negative. And I'll show a chart here in just a moment on that. As far as the inflation fears, what we had over this past week is we had the Advance GDP. That's the big measure of the U.S. economy. And this brought about stagflation fears. That's what we lived with back in the 1970s, when you had super high inflation but really no growth. And that's what the problem seems to be, at least right now. It could change. Real GDP ended up decreasing at an annual rate of 1.4%. The definition of a recession is if you have declining GDP for 2 quarters, that is now a recession. Most people expected the GDP to be up 1.1%. Now, this was the advanced GDP. There's going to be a final release of the GDP. Who knows how that will be modified? Inside the GDP report is a thing called the Chain Deflator, and it increased 8%. Most expected it to be up 7.3%. 7.3 is still pretty high, but 8% is a lot higher, and that really caused a lot of concern. Except Thursday, when this came out, stocks really looked like they were rebounding. Things were really looking good. Well, this report kind of went unnoticed, but more in hindsight was used as a real excuse for things to decline on Friday. There was also the PCE report that came out this past week. It surged 0.9%, and that's month over month, which on an annualized rate is 6.6%. They expected it to be at 6.3%. That may not sound like very much, but the market fixes into this 6.3 number, and then when it comes in higher than that, they're like, oh my gosh, we need to adjust things. So yeah, a little tiny number can really make a difference sometimes. The first quarter employment cost index also increased 1.4%, and this was higher than expected, where they were looking at a 1.1% increase. So taken together, we saw a lot more of inflationary fears and a potential recession that might be coming our way. Here's the intraday look, and on this chart, you have to kind of start in about the middle. Here's Monday, where we gapped lower at the open, and then we ended up not having a really good day, but we were able to recover near the end of the day. On Tuesday, we gapped lower and ended up closing right at the low. Wednesday, we just pretty much chopped sideways. Thursday looked like, oh boy, here we go. We're really bouncing back. It was a real strong up day. Well, on Friday, we gapped lower. We gave up not only all of the gains that we had on Thursday, we went even below that. We went down below S2 and closed right near the low. So it was a pretty negative week. And this was also the end of the month, and April was not a really good month for the markets either. Here's how we look over the past week. With the NYSE, everything was down. The NYSE was down the least at 2.74%. The Dow was down 3.15%. Mid caps were down 3.74%. The S&P was down 3.82%. Small caps were down 3.93%. And then the NASDAQ really took it on the chin, with the NASDAQ 100 being down a little over 5%, and the NASDAQ itself down even more than 5%. So it was a pretty negative week overall. So here's another look at just how things went. The Dow was down 2.5%, NASDAQ down 3.9%, S&P 3.3%, Russell, which are the small caps, that was down 3.9%. So let's go through the sectors. And I kind of reverse organize these, where the one that had the least amount of loss, that's at the top. Everything was down. And the one that got hit the most over the past week was discretionary. That's really been getting hit hard, because these are what we call more like luxury items, things that you don't really have to have, but just make life more fun. And when the economy really starts tightening up, those are the first things to go. Then this just shows how things performed over the previous week. Energy was up 2%, and discretionary down over 8%. And if you want to pause this and look at that, you might find that useful. But this just goes back the 5 days that we traded of the previous week. By the time I was recording this, the current market valuation did update their charts. They're currently still at fair valued, and that's pretty much because of the yield curve. They use a different yield curve than what I look at. We still have the 10-year to the 5-year inverted right now. Some people might go, oh my, that's not really a big deal. Out of all the different yield curves that I chart, that one is inverted. And so if you're more conservative with how you look at things, you still don't really like that. They use, for this model, the 10-year to the 3-month. And that's been doing fine all along. And so we've been getting a more fairly valued look. And as I usually point out, the charts behind the text right here, these are real charts. They're updated. So we can read a little bit about it on the front and then see the actual updated chart behind it. The Buffett indicator, which is comparing stocks to GDP, even though it had been a lot higher, did come down a little bit. We're still overvalued with that. The PE ratio, after being pretty extreme, is also coming down. Interest rates are considered fairly valued because even though they're going up, they're still historically low. Margin debt finally updated, even though we're still about a month behind, and it did decrease, and so that makes us more fairly valued. And then the mean reversion, which how far are we getting away from the mean price of the S&P 500? When we get far away to the upside, we get into the red area. Now we're back. We're still above it, and we're still overvalued, but we're back into the yellow area, so it's not seen as quite as bad. As far as sentiment, I wanted to bring this up because we're starting to get extreme, and this is after Friday that we're down at 27, and here's a historical chart where usually when we drop down below 25, that's when we're seeing more excessive fear, and we tend to use that as a contrary indicator. Also, this past week, we had the Aai Weekly Summary, and this is one of the lowest readings we've seen in a long time, in like 30 years or so. Individual investors are very, very bearish right now, which we can also use as a contrary indicator. In the past week, the ratio, the RIDEX ratio from bearish funds to bullish funds, it did go up a little bit. We're at 0.07 right now. But it's not necessarily extreme, but it's just showing that a lot of fear is coming back into the markets. The VIX also really spiked up. Here's the line showing the closing value, and then here's the bar for the week. We could still go higher than where we're at right now, but we're just seeing a real increase in fear overall. When the markets go down, fear goes up. The VIX also goes up. The Ulcer Index is also coming up just a little bit. It's looking a little bit more pronounced on the daily chart, but we're seeing just a little bit of uptick in fear where we're right about at the moving average. Then looking at the economy, according to the Chicago Fed Financial Conditions Index, when we go above this black line, that's when things really turn scary. Well, look at where we're at right now. We're still below. So according to this chart, the economy is not freaking out right now. Now, this could change, and this chart can really spike up quickly. But this goes all the way back to, I believe, 1971. So this gives you a long-term view of this. Also, looking at the different loans that are out there, when this really spikes up, that means that the riskier loans are in danger of not being repaid. It happened back in the financial meltdown. It happened back right in about 2001 after the dot-com bust. It happened during the COVID plunge. Well, we're not really spiking up currently. So we'll just keep an eye on this because this could change quickly. But right now, these charts suggest that the economy is not doing all that bad. Also, this past week, you have active asset managers. These are the ones in mutual funds or hedge funds who are getting into investments and then they get out of that and get into another one. They're looking for dividends. They're looking for different markets that they can get involved in. Whereas a passive mutual fund, that is just invested in the S&P or the Dow or the NASDAQ. As this number goes up, that means that these asset managers are increasing their exposure to risk, which means they're buying more stocks. When this goes down, that means that they're decreasing their exposure to risk. Well, over the past week, we saw a little bit of a spike up in the latest reading. Then we also had the final reading of the University of Michigan Consumer Sentiment, and it's pretty low. It's at 65.2, which is like, okay, what does that mean? Well, you can see this blue line here just shows where people are just not happy right now. One thing that we do on this chart is we compare it to the 2-year Treasury yield. In a good, solid environment, it's okay to see interest rates going up, this red line, as long as people are feeling happier for the most part along the way. What we're seeing right now is interest rates are really going up and people are just not very happy. We've bounced back a little bit, and really the reason we bounce back is that people are hoping that things will look better in the future. They're not really feeling good about things right now. They're just hoping that things will get better somewhere down the line. And then down below, this just shows the difference between the red line and the blue line. As far as the Fed, we've got the meeting coming up. Right now, there is a 97.1% chance that after Wednesday's meeting, we will be up 50 basis points or 0.5% to 0.75%, and then that's a range that goes all the way up to 1%. And here's the historical chart, where at the beginning of March, it's like, we didn't even really consider that. And as March went by, as April went by, this became the prevailing probability. Then looking out to the June 15th meeting, there's an 88% chance that they're going to raise rates another 0.5%, and that we'll be at 1.5 to 1.75 after that. And then here's the historical chart, just to look at this. I know it looks all scary. Then when we look out at the July 27th meeting, there's an 82.7% chance that we're going to raise rates again, and we'll be at 2% to 2.25%. And here's the historical chart to look at that. We're still getting these reports that the Fed is doing their quantitative easing. The Fed balance sheet continues to expand. Now, expect some kind of an announcement made at this week's FOMC meeting. They may say we're going to stop quantitative easing, which means buying bonds, both corporate bonds and especially treasury bonds, and that's how they flood the U.S. economy with liquidity. They're supposedly going to stop doing that. And then we have this taper tantrum. If you go back to 2018, where you see this line starting to decrease, that is when the Fed started to get rid of these bonds that they were buying. What's that going to do to interest rates if they sell them over a period of time? Is that going to push up interest rates? That's the big debate. right now. As far as breadth over the past week, we're seeing a real decline based on price as well as a decline based on volume. Then here's a thing called the Advance Decline Ratio, which is a 19-period exponential moving average. That's the blue line, and it moves faster. And then a 39-period exponential moving average. That's the red line. And this just gives us an idea of the overall trend. Well, both of these moving averages are declining currently. Looking at the new highs and new lows, the new highs are in green, the new lows are in red. I'm trying to add some more annotations to the charts these days. Down here we have the new high minus new low index with a forward period simple moving average, and it just shows that we are declining. The important number right here is the red line. Then we have a 10-period moving average down below, and that is declining and actually going below the red line, which is a little bit more negative. So internally, we're seeing some weakness in the S&P right now. Accumulation buying versus distribution selling, we saw that really drop off and fall below the moving average over the last week. As far as our trend, the negative trend is picking up some steam. We're above 20. The red line is on top and advancing, and the green line is declining. So we, on a longer term basis, are in a negative trend right now that could be getting stronger. The Arun also is showing that selling pressure has subsided a little bit. When this red line is way near the top, whatever is way near the top, that means that part of the market is in control. If this is green, pegged near the top, that means buyers are in control. If the red line is near the top, that means sellers are in control. Well, we spiked up and then have been coming back down, but buying power has also been coming down. Because the green line is below the red line, that makes our oscillator negative overall, but we've been kind of flatlining when you compare the two lines with each other. The mass index, now, we went above 27. We're getting ready to drop down potentially below 26.5, and we'll have to see, will that trigger some kind of a signal? Long-term charts, there was a change this past week with the decision point scorecard. Short term, which is not what we really deal with in this video, we're negative with the price momentum oscillators. There was a switch in the past week. We went more neutral with their trend model, and then they switched with the PMO to a long-term negative trend with the PMOs. So that's why I wanted to show this. Our pivots showed that we are below the pivot and we're in danger of coming down to S1. If we do fall, will that provide support? And you can see here, we're getting dangerously close to lows that we set before. So far, that's holding up. Is that just a test? Are we going to be able to bounce off of that? Or are we going to break down and keep going further down than we already have? At the bottom, you can see where volume was above average. Looking at the 50-period simple moving average, we are below by quite a bit, actually, the 50-period moving average, so that's more negative. This is the trend, which takes two moving averages, the 13-period, which is blue, and the 50-period, which is red, and we are seeing a recent death cross with price below both moving averages. Bullish percent index is also declining below 50. That's negative number one. Number two is that it's declining, but we're not necessarily extreme right now. These are the number of point-and-figure sell signals now that are being generated within the S&P 500. Here's the Chaikin oscillator looking at longer term. We're getting down to an extreme negative reading. So we might be a bit oversold on a long-term basis according to this indicator. Chaikin money flow continues to be negative and is still declining. The force index also red means negative and still declining. McClellan oscillator declining and getting down to an extreme negative reading. It can still go lower than this, but we're starting to get a little extreme on a longer term basis. Here's the summation index declining based on price, and we're below the midpoint here, the 0, and we're also declining based on volume and not necessarily extreme right now. All of our momentum oscillators are now switching back to negative. Some didn't even switch. Some just continued. And I've stated before, that I'm not a big fan of oscillators when it comes to long-term charts, but some of you do use them. Looking at the PMO, specifically the middle area, price, we're seeing a decline. Volume, we're seeing a decline. The percent of rising PMOs inside the S&P is getting extreme negative. The percent of PMO buy signals, we're starting to get extreme negative. The percent of PMOs that are even above zero, that are positive, that is declining and not necessarily extreme, but it is declining. The RSI, based on 14 periods, we're below 50 and declining and not necessarily extreme. Special K, this is kind of one of the holdouts right now. This is a longer-term trend measure that we use, and this continues to be positive over the longer term. Swinland Trading Oscillator, negative based on price, negative based on volume. Stoke RSI, pegged negative. Williams percent R, pegged negative. And when I mean that, I mean extreme negative. Oversold negative. The Vortex, negative, with the red line on top and advancing, with the green line actually turning up a little bit, but it's still below the red line. Ultimate Oscillator, below 50 and declining. Money Flow Indicator, going down a little bit and still below 50. Bollinger Band, we're negative because we're below that dashed line and not necessarily giving an extreme reading. The KST, another longer term measure that we look at. I haven't really been showing this in the weekly videos because this has been negative for such a long period of time when clearly we were going up. So I'm not quite sure what to make of this. And KST just means no sure thing, with a play on words there. The PPO, another oscillator that I don't show all that much, the percentage price oscillator, it is declining with the histogram also going down. The rate of change based on 1 week just shows how we've declined. And we're down near the green line, which is kind of extreme, but we could even go lower than that. Looking at the 50-period rate of change, we just dropped below the dashed line for the first time in since the COVID plunge. We're not really extreme negative. We're just at -1. But the fact that we are negative ever since the plunge just means that things are turning more negative. Here's another thing called the Copic Curve. This is pretty good at picking out bottoms in the market. It's not really telling us anything right now. We wait to see when this is going down, when it starts to turn back up. That's when we really pay attention. Our different charts, the Heiken Ashi is negative with a dark bar. Kegi is negative, it's turning red. Renko is negative with a red box. The point and figure chart, we have a double bottom breakdown that was generated back on April 11th, and there are some new circles that have been drawn. And we're at some pretty significant support right here. These zeros are showing that we're kind of at a real vulnerable place right now. If we really break below that, that could turn things quite a bit more negative. The equivolume just shows where the ease of movement indicator actually advanced a little bit over the past week, but from week over week, we did decline. Our different trading systems, the Elder Impulse is negative with a red bar and a declining MACD on the bottom and below zero. The parabolic SAR, we, for the first time now, are seeing a dot above the bar. That's negative. So this is switched over to a negative signal as well. Looking at the broad market, here's just a weekly chart of the S&P showing that we're kind of at some pretty critical support. Mid caps also at some support levels. Small caps, we've actually broken down a little bit below support as well. All stocks, taking U.S. stocks and a lot of world stocks into consideration, we are breaking below the low here and we are negative. Mid caps, and you're going to hear a lot of the same thing here. Recent death cross, currently below both moving averages. Small caps, same thing, death cross below. The Dow, death cross, and we're kind of at critical support right now with the Dow. Then looking at Dow theory, the Dow is the very top here. Here's the transports. I don't really have anything to talk about necessarily with this. I just like to show this to you. And then the utilities are on the bottom. They've been really doing well, but the last week they got hit pretty hard. NASDAQ, death cross, breaking down. NASDAQ 100, death cross, breaking down. NYSE, death cross and at support. Wilshire, death crossed, kind of not quite at support, but could be. FANG stocks, they got hit not too bad over the past week. And you notice I have two A's there. Facebook, Amazon, Apple, Netflix, Google. That's what that's supposed to mean. But our growth stocks are just having a lot of trouble right now. ARC Innovation was down over 10% on the week. The Dynamic Software Intellidex Index, these are the 30 big U.S. software companies. That's why I include this, because it's a big part of the growth industry that declines and is currently in a negative trend. Then this is another thing that we're watching for, and this is one of the scenarios that I've been talking about in the daily videos, where sometimes when you take a ratio of the staples to the S&P, and when that spikes and starts to turn down, sometimes that suggests that we hit a bottom in the S&P. Now, this is a daily chart here. And the problem that we have with this is we don't know if we've spiked. Sure, we went down a little bit over on Friday, but is that a spike? I mean, you could say that we spiked even further down before. That's one of the reasons why I have a moving average plotted on here to kind of help us. But this is just one of the signals that we can use to look at to say, oh, maybe we're finding a bottom in the market. Broad market things. Here's the Crb Index. Over here is this is the breakdown, and this is what I use to gauge inflation, but it's in an overall uptrend. Gold, also in an uptrend. Silver, it's not looking all that great these days, but it's still in a basic uptrend, and it's trying to do a golden cross. Oil is at 104.69 for the week. The dollar's just been screaming. We were actually above 103 at one point. We ended up settling down at 102.96, but it's been doing really well. And if you want to hear more about that, watch some of the daily videos, because there's some concerning things coming out of Japan which may eventually affect the U.S. economy, which might help explain why the dollar's doing really well and the yen is not doing well, and even the euro is having some trouble right now. Then looking at some relative studies, and I don't go into as much depth as I usually do on some of the daily videos, bonds are really underperforming the SPY right now. Probably not a big surprise. Then looking at the stock bond ratio on a monthly basis, stocks are just really outperforming bonds and have been for quite a while. Here's intermarket analysis going back to December 31st. It just shows where oil has been performing the best, then gold, and then the dollar even actually starting to outperform gold. The S&P is declining, and bonds based on price, they're performing the worst. Here's a look at the gold to the US dollar ratio, where the dollar's been going up. Gold, it's been hanging in there, not doing great, but overall gold has been underperforming the US dollar lately. Here's the gold to the S&P, where it's outperforming stocks. Then here's some low volatility stocks inside the S&P 500. You can get an ETF based on that, and the low volatility stocks are what people get into when they're more defensive. It just shows where we're really outperforming the SPY. Growth, value, growth down, value up. NASDAQ 100 is underperforming the S&P 500. The biggest stocks, which are the S&P 100, are underperforming the S&P 500. And those 100 stocks are your growth stocks. Discretionary is underperforming staples. And then energy and tech. Energy's really doing well. Tech, not so good. So what's our outlook then for the coming week? Some major economic reports that'll be coming out on Monday. We have the ISM Manufacturing Index and construction spending. Then on Wednesday, we'll have the IHS Market Services PMI, the final reading for that. Also the ISM Non-Manufacturing Index. We got the Manufacturing Index, I believe, this past week. And then the FOMC meeting. That's the big deal on Wednesday. That's what everybody's going to be talking about. And then on Friday, we have the employment situation report. This is when they come out with the unemployment rate, the number of new jobs, and all that stuff that comes with that report. So what are some things that we're going to watch? Of course, the technicals, and they're quite negative right now. We're going to be watching inflation and interest rates over the coming week. A lot of geopolitical concerns. This Russia, Ukraine, things going on in China, issues with the supply chain, oil, Fed speak. Well, there's going to be a lot of Fed speak. There'll usually be the press conference afterwards, and the markets will pick a way that they want to go after that. Earnings will be coming out this week, and then I've added Japan to this thing, and I'm doing some more research on that with some things that could be a concern in the future. So what are some of the scenarios that we're looking at? Down. We are in a downtrend right now. This is just based for Monday. I rework the scenarios every day. Rising interest rates and inflation fears. If they keep going up, then that could push stocks down. Earnings and Fed speak and different things that spook the markets. The technicals, they're negative right now, but on a short-term basis, they are oversold. So you think we might get some kind of a bounce, at least short-term, a day or two. The up scenario, we are short-term and a little bit even intermediate-term oversold right now. Now, these are some scenarios that are not necessarily on the table right now, but things that I'm kind of watching for. Longer-term bottom signals in some of the charts that I didn't show here that could be setting up to generate signals. And these are pretty good at picking good bottom signs. Another thing is we sometimes will have a positive backdrop after the yield curve reinverts. Well, part of our yield curve is still inverted, and there can be a time lag. It doesn't mean right when we switch back, everything's going to shoot to the moon. There can be a delay, and we don't know if the yield curve is done being inverted yet. Another thing is the chart that I showed you, the Staples ratio spike. We don't know if that's really topped out yet. And then there's another one that I didn't show. It's the 2-year yield spike. I did show the 2-year yield as it relates to consumer sentiment, but not as it applies to the S&P. Sometimes when the 2-year yield spikes and then starts going down, that can be a bottom in the S&P. And then this small cap thrust prior to the S&P 500 thrust, that worked really well for us in the middle of March, where a few days before the S&P took off, small caps on a relational basis were outperforming, and sometimes that can give us a bit of a clue. Not always, but we watch for that just to see if that's what's happening. Then the technicals, we are negative overall. So the different areas that may provide some support would be moving averages, but we're below all of those. Probably going to be pivot points and previous lows. If we're going to go back into a sideways trend, the ADX is right now above 20, at least on a daily basis and on a weekly basis. If we drop below that, then we might get back into a sideways pattern. We're not really in danger of doing that with the weekly chart. So thank you very much. I hope that you have a very good week, and I'll prepare the next video next weekend.